So the market pretty much asleep, kind of boring, and we do talk a bit about that, but really it's a time to look at some more of the minutiae and seeing what could be around the corner. So keep in touch, we'll keep viewing as we look at the refinery economics out of China, some of the minutiae in the North Sea, some of the winners and losers as always, and again running through macro stories and the like. So a reminder, unfortunately this will be the last episode of the Flux News Show in its current format. So from Wednesday next week, we will launch our new show, Flux Insights, and that will be on Flux.live exclusively. This isn't the end though. There will be more shows to come, more focused on the retail audience, the speculating side of things. We're going to talk about weather, we're going to talk about power and gas, all newer shows to get you as the end user more involved, both from a speculating point of view and a hedging point of view. We're really excited to show you all that. So again, hope you enjoy the final episode and see you again soon. So Martha, Waj and Harry, deflating balloon, right? That's not like any secret or anything. Just not really much of a temperature at all, right?
Yeah, feels like it. You said yesterday it's just kind of cooling down, but yeah. So
I think it's not even for me. It's like it had been cooling down.
It's remaining cool.
It's just like, this is the most deflated I've seen the market in a long time. I don't feel like we're going to have epic amounts to go through. But Martha, why don't you just whack up the chart to kind of prove our point?
Yeah, so looking at just a couple of technical indicators on front month Brent, volatility from means of standard deviation saw a really significant pinch, which often precedes a breakout, which is could have been exciting, but we've just seen that pinch kind of continue to narrow. So people are saying, oh, well, this must precede a breakout. But yeah, I mean, we see this really narrow channel in the Bollinger Bands, which shows volatility is low. Prices have been sandwiched between the 100 and 200-day moving average. We've got kind of an uptrend here with the white dotted line, but I mean, we're just hitting 70 and then selling starts. And that's the price that people have been happy to sell at. And you can see that from these longer upper shadows when we hit 70, which shows that prices are getting up there, but they're not closing above there.
Yeah, it's like, you know, people might say something like, oh, you know, it's temporary. And as you said, you're looking for a breakout. But I have seen, like, do you remember 2014? I think you were trading then.
Just started.
It was actually, funnily enough, Crimea was getting invaded at the time. It was at the beginning of the Russia-Ukraine kind of tension way back when. And we thought, oh, bull run and whatever. It was like dead. Like the June deck Brent spreads, I remember traded within like a 3-cent range all day and like for every day. And it just took so long to get interesting again. I think that's just kind of what happens after you've been through so much and there's just no real narrative either way to get really excited about. It's like, I don't even think we've seen the end of the death of volatility. It's basically what I'm saying.
Yeah.
A lot more boring, even though this is already boring. But anyway, why don't we dig a bit more into it on the options side maybe first?
Yeah, of course. So this is looking at, so options for the September contract expired yesterday. So this is looking at the most recent data, obviously 2 days, T-2 for open interest for the September option. Come see here. So as we've been saying, you know, for the past however many weeks, we've still got that really significant open interest at 95, which can be exciting given that it was expiry, but it's just so far away from the price we're trending at. Implied volatility is really, really low. I'll show that on the screen as well. So that's this is over a fairly long period of time, but you can see that's just been going down and down, and realized volatility was higher than implied volatility, but that was making little difference. That we didn't see any significant kind of being drawn to specific like points of open interest in the options. It was really just a very quiet day.
And I guess the open interest is just for those kind of like high strike calls. It's just not going to change because they're just worthless, right? There's no point in selling it because you're just selling, like, you know, for 1 cent or something. You might as well just keep it.
Of course, yeah. And I think there's a lot of like money being made in those final bits, right? So they take, like, someone who's like, say, long the option, you might as well sell it for 3 cents because it's 3 cents instead of 0.
Yeah.
So there's market makers there who'll just be like, cool, I'll just take that 3 cents to expiry. You do that enough times, not bad money, right? But I think also with options expiries, they sometimes used as almost like a call to action to the market, being like, oh, don't forget this option expiry is coming up and this could be really crazy. But that assumes that there's a lot of action or a lot of open interest, a lot of risk around the level it is right now, I think, because if it's not, there's just, as you say, there's just nothing to do really.
Yeah.
It's all hedged out and blah, 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 blah. So that kind of paints a pretty boring picture by itself. What about the volumes?
And then volumes, this is from the officials who we'll cross to later. They also showed people are not trading, that we're down 25% week on week in Brent, and we're just seeing those week on week drops all across the board.
That's massive.
Yeah.
This is week down 25% globally. Fucking hell.
In September, yeah. It's pretty much looking like this across the board. And I know a couple of weeks ago we saw that volumes in heating oil and gas oil were really, really high, but we're not seeing that so much now. We're seeing that rally kind of starting to peter off. We're seeing a bit more mixed fundamental news, although the stocks are really low, but we'll get to that later. But yeah, pretty grim across the board.
Yeah, it's funny to look at the gas on heating oil volumes being so down as well, because that's been the driver. And that's what a narrative we've clung to find something interesting in the past few weeks. But even that, open interests, or at least volume, has gone down quite considerably, maybe suggesting that hype even is now coming to an end.
Yeah, everyone got a bit overexcited after the July.
Well, as they kind of should have done.
Yeah, they should have. Yeah,
it's just now maybe we'll go through it, but it's just that was our last hope for
any sort of excitement. Yeah.
Okay, so whatever we can say, I don't know. Max worst temperature, just 0 basically.
Yeah.
Okay, let's go to the herd mentality. The herd is asleep.
Yeah, very bored.
The cows are lying down, yeah. I think the thing that people are talking about at the moment are trade deals. We've got one with Japan and one with the EU happening recently. I think lots of kind of more retail focused headlines saying that there is this huge deal with the US energy with the EU, but I think this is kind of a nothing burger. So there's been this MOU of kind of the EU promising to buy what's $250 billion of US energy. And right now on the screen, so this is the projected estimations we can have for the different contracts that we have. The EU purchased about $100 billion in US products in 2024. So 60 bill from just oil and gas, and then 20 bill from LNG, which is the main way that we can see this kind of progressing. But right now there's quite a lot of issues with LNG exports. They've kind of been developing their LNG production as much as possible, as you would, but they're just not they weren't expecting to be having to do this kind of production. And that is even before coming back to saying, okay, so what the EU's promised to do it, but, energy companies are private companies. What are they going to force them to do,
Yeah, that's the bit I find interesting. It's like, you have to buy oil and gas.
The EU doesn't buy oil and gas.
If anything, it's the American companies in Europe buying, they own companies in Europe, refineries in Europe, trade hubs in Europe, to come and bring it over. So maybe the EU is suggesting they could incentivize it in some way, and replacing Russian LNG. So, no, they're just going to say you can't buy Russian LNG, and so then you have to go to the open market and get the best price for your LNG, and that could be Qatar, that could be anywhere, or the US. But the only thing I would say on that is, when you say, how is the US going to be able to supply? I would never bet against the US being able to produce way more than people expect. I mean, they're the ultimate, innovators, and
I think it would need a lot of infrastructure expansion.
But I think they'll do it. I mean, I remember the export capacity. Again, it was classic bulls trying to talk down. They always try and talk down US shale because it's the one that's always surprised in the past, and it ruins people's models who want to be bullish. But I think, as I say, it's always been proven, there's money to be made. They'll find a way to build to make it, especially with Trump in power, right? It's going to be moving heaven and earth to get your licenses and all that kind of stuff. So that's what I would say on that. But I agree, a bit of a nothing burger.
It feels like a bit also, if they turn around in a year and say, well, we didn't, what are you going to do about it? I imagine it's just one of these kind of PR wins.
Yeah,
it's like,
PR
what would they do if they spent 230 billion on energy?
Yeah. But that said, 0% tariffs into EU, so it might be cheap for people to do it. So that does mean more imports for oil and gas from US. That does affect the pricing, at least the way it is. I think the officials might be mentioning something about that in a bit. But the point is that US's role in Europe for energy security is obviously going to become huge, which is kind of the way it should be. It's proper ally, right? Versus,
I was going to say, it's not necessarily a bad thing, is it?
no, but it gives obviously a lot of control to the US.
Yeah.
The big talk is like, this is just playing into the narratives that the EU is dying. I think we talked about it last week. EU and UK kind of screwed. Is playing into that narrative again. So I kind of want to just move on, really. That's I know what you mean. That's the herd mentality in terms of that's the only real news that's kind of been making headlines. But anything else? I guess.
I mean, like, I suppose there's an OPEC meeting coming up at the weekend, but
sure. Yeah. I guess again,
it doesn't really feel like any volatility is priced in until.
Well, it's another unwind expected. And again, like I think we've been relatively on top of this in the sense of, especially the officials guys, they've keep banging the drum that these production increases are not real. They've been there all the time. They're just on paper. And I think the perfect evidence for that is the Brent versus Dubai differential, right? That should be rallying like mad given how low it is historically, and its normal levels are 3, 4, 5. It's now almost, well, it's definitely negative in the front, -1, and it's kind of negative all the way down to the rest of the year almost, which is like pretty nuts because that's just indicating that there's like barely any Middle East supply compared to Western, which I just don't think is true. But I think, with the demand, I think we talked about this, the refiners being more Eastern, so they lap up the local grades, the distillate and fuel doing well this year. So it all plays into OPEC style crude being bid versus Western crude being lighter. So it kind of makes sense, but it also shows you that even with production increases, the market is just shrugging it off, right? I mean, it's that for me would be a big fundamental indicator that there's too much Middle Eastern supply. Of course, it's a proxy, but it's just the opposite. I mean, to be -1 in these conditions is pretty telling. So, but anyway, more news on Russia, Ukraine, right?
Yeah, I mean, Trump's come out and he said new deadline, 10 to 12 days. And the market, again, didn't really react to that. The only thing to say about that is that India, of course, would have to pay these secondary sanctions significantly.
Yeah, I'll tell you another way the EU could get screwed, and that is Russia do make a deal. They make the deal with the US. The US agreed to have more close trade ties, but the EU don't want those close ties with Russia. So essentially what you end up getting is a bit like the rerouting we had in 22 with supply, like US supply, but they could probably get cheaper oil and gas from Russia to resupply into Europe. A bit like how the Indians have been doing it via diesel, buy the crude from Russia, refine it, make diesel, send it back to Europe. You basically have the same kind of thing in US because you want your energy security from US, you're not willing to have from Russia, but US don't mind dealing with Russia. That would just be classic. And I think that probably looks like that's on the cards. So if anything, that's... what do we think? It can't really be bullish or bearish the outright prices. It's just rebalancing a supply. But
if anything, kind of like European domestic prices would be like squeezed higher.
Similar to 2022, basically. You're getting a restructuring of the arb flows. It's great for oil traders. Like the import locations is where the kind of price gets squeezed.
Because you're having to pay for 2 more middlemen and another sort of like few thousand miles of freight.
Well, again, I'm boring myself.
We're trying our hardest.
Okay, well, what else is there on the horizon? Maybe we've got we're in the middle of summer or getting towards peak summer, so maybe driving season and hurricane. Again, right? It
might be a busy end of hurricane season. Right now, it is in the. Which is the Pacific, the Western Pacific, is it? That's really busy, but they're all kind of going away from land. I think we've got the Saharan dust quite badly at the moment. When that goes, there should be some better waves able to come across and some hurricanes maybe forming.
Right, well, that could be a surprise. And I don't think the market is kind of too saturated either way, under or oversaturated, long or short. So I don't think there'll be big shock waves of volatility, but there could, a trend could like form in one of the products or something like that on the back of a hurricane. So I guess it's just kind of like wait and see mode ultimately, even for the herd. Good time to take a holiday. So all right, we'll move on to maybe talking a bit more about the potential impacts with the refiners we've seen lately, North Sea, the trade deals, that kind of stuff. So let's cross to the officials for this. Where's Wally? How's it going?
Well, so Yeah.
Where's Wally's?
We're in the same place again, though.
Yeah.
But
Yeah.
in the North Sea, it's been an interesting one lately because a few weeks ago we had a weird situation where 40s was really, really weak in the middle of the curve. And then that was cleared out and 40s curve was able to jump up. So it was no longer really setting the date benchmark. And now we're seeing a lot of Midland offers coming in and affecting the Midland curve. So like last week was really quite chaotic on Wednesday. We had like 5 grades all offered in the window and like it just stuff flying all over the place. The diff jumped up to around 90 cents. But since then, we've seen this real Midland glut just coming in and there's no one to clear it. It's not getting all these offers from the likes of Phillips and Chevron and Petronas. They're just not getting lifted.
Yeah.
And that means that we've got this excess of Midland coming into the North Sea. Referring back to the trade deal talk, if this EU pledge to buy $250 billion extra of US energy products does materialize, you could see even more Midland coming into the North Sea
Eventually.
if that becomes a feature. And so, really, Will, can you explain what that's done to the diff and how it affects things?
So, I mean, especially, as you said, towards kind of the belly and the back of the Midland curve, that's really been depressed relative to the other grades. The front has been a little bit more messy, but we're starting to get that. We're starting to see that kind of flush out, and it's really Midland driving the dated benchmark at the moment, and that's kind of pushed the physical diff down to around 32.5 cents yesterday. That was the lowest since May. So we've had in differentials in the North Sea last week, but things are starting to kind of trend lower, and I think a lot of that is to do with kind of the European reforms. You know, we had the Lindsay refinery down. Finally, after 2 weeks of trying to find a buyer, they failed to do so. So that will be shutting.
By the way, it's worth noting as well that Lindsay was particularly taking a lot of Midland.
Yeah.
It's taking 113,000 barrels a day of Midland.
Yeah, almost exclusively. Yeah. So that's almost an extra cargo a month. But Lindsay Refinery shutting down. We now think there's around 1 mil barrels a day of capacity offline in Europe. Although that's a little bit lower than in April, May, at the height of the maintenance season. That's still pretty high, given we're supposed to be in driving season, peak gas demand. I mean, margins have on the whole been supported, and largely as a function of diesel cracks remaining relatively robust. But gasoline has struggled relatively, especially given we're having
the time of year
driving season, as discussed in the podcast last week. So you kind of have this duality going on where in the east you have run rates flying up. You know, Shandong is now back over 50% capacity utilization. Independents nationally in China are at 63%, and state-owned over 85% capacity. So add in the China strategic stock builds as well as the increased run rates over there. And you have a pretty bearish Brent to buy mix on the refinery side.
And when it comes to the technicality of the actual dated, what's set in the dated curve, with the 40s example that we just mentioned, there wasn't like loads of 40s being offered into the window. It was a few cargoes here and there that just weren't being picked up for a week or two.
Yeah.
Whereas with Midland, there are so many offers coming in this week and end of last week that I think it will take a bit more than it did for the 40s example to lift the Midland curve back up again.
Yeah.
So I think there is potentially still some more downside to the physical diff there.
Yeah, for sure. And that kind of grade differential only widens as you get to the back of the 10D.
Yeah.
So there'd have to be a lot of Midland flushed out in the window to get the curve back up to where kind of the other grades are really trading.
Yeah, agree.
That's really useful on the Chinese run rate side of things because, they've got the market kind of really in balance in the sense that they've picked up the excess that could have been there, or at least they've picked up a lot of Saudi crude, OPEC crude to fill their stockpiles. We've talked about that a lot, but we also talked about how they haven't converted it into product. So we're not seeing if there is an excess in the products, which is where we'd start to build a compelling bearish narrative. So for them to be now ramping it up quite significantly is probably what we were waiting for, right? We're waiting for them to just basically use that very high stockpiles and get it into refining capacity and start to export. So I think the next thing really to be keeping an eye out is product quotas from China, right? We really need to keep an eye out for that, because it could all of a sudden very much surprise to the upside, basically giving the market their excess, using it all internally. And then when they've got too much, which you'd expect they're going to have, you would think quite quickly, given how much they've bought, then finally, I guess we could maybe see the margin starting to be threatened. So that's really useful for, thanks guys. All right. Let's move on to macro mayhem.
So the first bit of news today is that Gunvor has entered Japan's power futures market. This is especially kind of relevant right now because of the such strong increase in that kind of volumes data from the power side in the Far East. So there's been a doubling in volume on Japanese power derivatives in June compared to last year. So good time to get in for Gunvor.
Yeah, just generally speaking, the power markets, I don't know if I might have mentioned this stat before, but it's 8 to 10 times, financial volume is 8 to 10 times the underlying physical, compared with 60, 70 times for oil. So it's got a hell of a lot of growth to go. And also new markets, the difference with power is they're very localized. Like you have, with oil markets, a very well integrated situation, and largely speaking, gas as well, or like LNG at least. But power can be its own beast. I mean, you can literally France and Spain differentials, or France, Italy, they can just be completely out of whack, even though they're right next to each other. So it makes, I guess in a way, it's got to mean that it's harder to have benchmarks like we have in oil. Like North Sea oil can be used as a benchmark for 70% of the world's oil. You can't do that for power. You can't say Japan benchmark can be priced for the entire Asia, because it could be literally 500% different in price next door. So I think it makes sense that these not local, but like individual markets become bigger in time. So Japan's right now, we've got US is growing quite a bit. Obviously the EU European regions in power markets are probably the biggest. But yeah, I'm sure more will come up. Australia, like there's big ones.
It seems to be where like the kind of trade houses are deploying a lot of their the money they made over the last 5 years. Like so much of it seems to be going to like gas, power, metals. I guess they just
they got big into the renewable greenwashing thing, right? Like classic, right? So it was like investing left, right, and center, these ridiculously high levels for these assets that kind of all play into the gas and power market. So it was inevitable that more and more trading, and again, it's about like I was thinking as Martha was saying it, like accounting for doubling of volumes. What can you really say that's about? And it's like, well, just generally speaking, if they've got more contracts to supply electricity, it's in those contracts where they embed the derivatives, right? And that's where it gets interesting for them, because they can play on the volatility of the derivatives to create better basically pricing scenarios for them on the physical supply. So if it was just a purely physical market, it's kind of like just tenders, right? I'll supply you whatever the spot price is, whatever. But as soon as you involve a derivative contract, or as soon as you start to involve like multiple days pricing, look backs, all these like clever things in contracts, then the way you monetize that is derivatives. So a trade house like Gunvor or majors in these markets, what they're really doing most of the time is giving liquidity to the market, because what they're doing is they're just like trading against their physical contracts and just locking in, margin there, which is great for market makers, great for speculators taking the other side. And of course, they're going to be doing their own speculating. So when people say like, can't you just set up a market, like just trade that market? It's like, well, you've actually got to have quite passive flow to begin with. Like if you look at like a crypto market, right, it's just speculation. So people generally speculate long, don't they? So you're just fighting over speculating. That's not a great market to market make. That's not a great functioning market in terms of like deeply liquid and stable and all the rest of it. So I always say that if you want us to get a market going, like we want to see who the sell side hedges are, who the buy side hedges are, Yes, you want a couple of spec people to hold volume, to warehouse volume. And then obviously market makers can bring together all the cross regions, cross timing and all that.
Yeah, you want to make like a sort of existing market efficient, whereas like you say with crypto, it's just like what can you really add to that market basically? Basically just like
more specs.
Like just selling into like, you know, there's like endless like wave of buying basically.
Well, I do think it's changing because if more people are putting on their balance sheet as like real treasury.
Yeah.
So that will then be hedging. So it's like, okay, now we need to actually, you know, hedge Bitcoin because like the same way we hedge dollar sterling.
Yeah.
Like if you need to constantly convert dollars or whatever into Bitcoin, then you do have a natural hedging flow coming in there. So I think as markets progress, I was just making the point, like to arbitrarily say go into a new market and get it started, you got to think like why, like who's going to actually hedge off the back of it, and then if you think there's promise there, then it can start to brew. Because we've just seen people say like, oh, can you give us like, can you start liquidity on what was the other one, asphalt in somewhere? And we're like, all right, okay, what are you going to do then? Like, why do you want that? Oh, okay, well, we're sell side hedges. It's like, okay, where am I going to get the buy side hedging from? So I'm just going to buy your sell side liquidity and take all the risk on your trading. It's not that easy to do. I don't know if you remember the Canadian crude stuff, like a while back. Canadian crude diffs was so deeply negative to WTI, and then WTI was so deeply negative to Brent. It was like a big, like massive disjointing North Americans versus the rest of the world oil. And so people, like when we were talking about this with fuel, like negative prices or negative differentials, those are the ones people want to hedge because that's where you get most screwed, right?
Yeah.
So as in like Canadian crude, if you can't sell down into Cushing because the pipeline capacity is all like maxed out, the differentials go from -15 to -20. It's $5 per barrel you've lost. So all the producers want to hedge, but then there's only producers of Canadian.
Yeah.
So the end users, like, I mean, the end user liquidity I didn't seem like there was any interest. So what they wanted you to do was just come in and face the banks who had all this credit flow, financing flow from producers to sell into you. Yeah, cool, I'll just buy it. It's like there's no pair, there's no like offsetting. Canadian crude is deeply specific, right?
Yeah.
So that never got going.
And like you say, with like a really like limited pipeline capacity, it's just like what I'm just buying something that physically can't be moved out of.
Yeah.
It's like by all definitions a glut.
Yeah, exactly. Well, if you look at how like the first DFL contract or the first oil swap trade was a DFL, I think, and it was I can't actually exactly remember, but basically they found a way to have two-way flow, and it was both hedging, and it was like, right, we'll just match each other off, and then it was a function for both, and then that is a market, and then you can get that going. So I guess that's what I'm saying. Like if you're going to want to start a market like asphalt, it's like, all right, I need a buyer and a seller, and then we can just start like proving its validity as like a benchmark, as it's useful to hedge against physical, and then you're away. So Japanese power, there's been a lot of interest, a lot of talk about it, because I think it's already gone through that process. Right? There's people, there's buyers and sellers, there's people making money. Okay, now everyone's interested, and now it's away. So could be a very interesting one. I think we'll be talking more and more about power and gas as we go on with our podcasts and shows. But anyway, that was just the Gumball news. But anything else?
Total's had an unfortunate Q2. It's a 23% fall in Q2 earnings, worst performance in 4 years. Just lower oil and gas really, and rise in production and power sales. But they've committed to $2 billion of quarterly buybacks at $70 a barrel.
So this is like not a big deal. I don't, when these things get released and people are saying like, oh no, they're about to release bad results. It's like, what do you expect, right? Like the whole industry is making less money because way less volatility is the main thing, and prices are lower. So I don't know. It's weird when people go, oh my God, worse than 4 years. It's like, because we've had the best 4 years ever.
Yeah.
Oil markets. But the only thing I would say is what's becoming more and more interesting, particularly for BP, but probably Total as well. Given how much money they've made in the 4 years from trading, it's harder and harder to block the fact that so much of their profitability is coming from trading. And no one wants a trading business as a valuation, right? Because, the general consensus is you can't apply much of a multiple to it because of what if your traders all get up and leave, which I don't think is very fair for a TOTSA type business, because they could, let go of the whole trading team, hire the randoms from the industry the next day, and still make a hell of a lot of money because it's the system that makes the money, right? It's all the embedded contracts. And to be honest, the traders probably don't like to hear this, but like, it's not about them, it's about the system. That's why these guys, when they go to hedge funds, they just do really badly, because it's like, suddenly you got a blank sheet of paper.
They underestimate the value of their seat.
massively.
Yeah.
Like you hear stories of these guys, you know, North Sea desks, some of these big majors, trade houses, starting the year like up multi-millions. And it's like, yeah, anyone can risk 10 million out of 70, can't they? And then maybe make 100.
Yeah.
But imagine starting from zero. There's no feeling like starting from zero, going -5 and having to fight your way up. Like if you've never had to do that, you don't really know what trading's all about, right? So if you're sitting in a seat at a bank where you've got loads of franchise flow, or a physical seat where you've got like all this physical head start, that is such a different business. And it's like great props to the people who built those businesses, because they're fantastic systems. But on the flip side, you get these traders who think like they're gods. They step outside because they think, well, I can have a crack at a fund because I'm a genius, and then it is fall flat on their face because it's a completely different gig. So I think it's harsh. My point is that equity analysts, when they look at a TOTSA or look at someone like a major and they've got a big, they're looking at their revenue and they're saying how much of that was trading. And naturally, you know, Shell or whoever, they're in these investor calls. They're like, like trading's a bit of it, but they're like, no, specifically how much? And they're like, we're not going to answer that question because they know they're going to get penalized. But I think that's bollocks, because that's definitely going to be around for 10 years, like 100%, right? And they're definitely going to make money. So like, why would you discount it?
Yeah, exactly. The more like the kind of higher the value of the seat, the more you should evaluate yourself to be like, it's good that you can leverage that, and you should. Yeah,
but like a pure trading house, like a hedge fund would be silly to put like a super high multiple on, because they can be -20%, up 20%. But you'll never find TOTSA losing money on their overall trading business. Like never, it just won't happen.
Yeah.
So why would you treat it the same way? I think it's super harsh. So I think you get like a 6p multiple. I haven't looked in a while, but yeah, profit to earnings ratio for majors and trade houses and all that, we're like 6, and that's pretty low. Like or like Goldman Sachs even, I think it's like I can't remember off the top of my head, but it's pretty low considering they've been around for ages. They're going to be around for ages, and they're going to make loads of money because they've got fantastic systems. So it's a bit of an odd one. Sorry, I'm just rounding now, but yeah, anything else on that?
No, yeah, exactly that. That's really interesting. And just the only other thing, we're talking about kind of where the blame gets thrown is the CEO coming and saying that traders are a little more cautious not to take direct positions, which can be hit by a tweet, kind of the blame a bit. But I mean,
but that's true.
Yeah, of course. Yeah. No one wants to be like,
Well, there's that concept of bad volatility as well, and maybe what I would say in that scenario is, if it's going to be constantly yin yang, that's probably okay. They're happy with that. But I guess what they more mean is like when you're building up a narrative, and that was kind of what we're saying at the beginning of the show. Let's say this year we're building up a bearish narrative. You're positioning all your physical flow and your general like position as a firm to optimize, to make more money if the market goes down than if it goes up. You like volatility in that scenario if its volatility is trending, but when one tweet sends you the complete other way, and again, like the Iranian situation, no one was excited about the underlying physical market at the time from a bullish perspective, and the general market was heavily positioned short, but you had to buy back, or remember we were talking, you had to buy insurance and all that. So the market hated it because it was unexpected and no one really believed in it, but they knew they had to take a step back. You can't expect people to make a lot of money in that scenario. So maybe that's the kind of thing.
And we're seeing this kind of, as you said, pattern across majors. I know Aramco had worse than expected earnings, and it is just a pattern in the industry. That's just how it's looking right now.
Yeah.
Yeah.
To be expected, though.
Yeah, that's why.
Yeah.
And then looking to the CTA positioning on the screen, we've got overall and then split up by product. We can see overall it's completely flat, and we've kind of seen a bit more of a dispersion of the separate products. We've got, as you would expect, heating oil and gas oil remaining positive, and TI and Brent have seen the largest reduction week on week. I think they're the most negative.
So nothing too exciting there.
No. I was waiting for a comment, but there's not really one to say.
Balloon,
more interestingly, I tried to get something with a bit of interest.
Well, again, what would we say about flat positioning is that with a flat book, let's say, and like the market literally has a flat book, even the CTAs have a flat book, that means when something happens again, people can invest.
There's a lot of spare capacity of VAR and risk.
It would be early trend, if that makes sense. Either way you look at it, right? So that's one thing to say.
Yeah. in the CFTC data for the week ending 22nd of July, we've seen the outright long positions in gas oil, ICE gas oil, European gas oil, the highest since February 2022. And you can see that it's just been pretty much week on week increases in net positioning from managed by money positions, so spec players. And I think it'd be interesting to see what these kind of funds and spec players thinking for the week after the 22nd, after we've seen the kind of prices flattening out a bit, whether they're like happy to kind of take some of their length off here, or whether they think, you know.
Yeah, that August gas oil, or the time spread August, it's trading a lot kind of heavier than that July August was just, there was just constant kind of like little hyperbolic moves to the upside. But that August spread has been really struggling to sort of break out again. I mean, it traded up to like kind of 28, I think, when all the July Aug madness was going on. But I mean, as of this morning, before I walked over, it was like 11.50 trading or something.
Yeah.
And it's like, it kind of moves up in grinds higher and then just drops a couple of bucks. So it does feel like that's quite heavily positioned along that spread, and subsequently the futures. It's just kind of struggling just doesn't feel like there's kind of that like capacity of buyers who really want to go for it.
But the market is long, we think, from a spec basis.
Yeah.
So it is heavy then.
Yeah.
So if anything, it could collapse.
Yeah.
Go on.
We've got some cargo coming into Europe as well, due on the 5th of September, I think, from Asia. So, I mean, the news came out like a couple of days ago, so we've seen better selling. I know Oil Bandit was on Twitter yesterday being like, it's collapsing, but it hasn't. It's dropped a bit. It's like a correction, but I think we are seeing like better selling when we're rallying now, so it could collapse,
We used the crypto analogy. It's like when you get dips in crypto or Bitcoin. So it's a long only market. So this is how it looks. You get aggressive pullbacks because there's no one interested in being short, but that means that when people kind of short term need liquidity on the on the buy side to sell, like it just gaps down.
Yeah.
But then it kind of finds its way back up, and it becomes increasingly volatile. But you're saying it's kind of less volatile now because we've had those spikes. We've had those drawbacks and those spikes, had all the stop outs.
It feels like if anything now, it's just the kind of like you get those kind of like sharp moves down, and then like it kind of grinds higher again, and then you get another shot, like you said.
Yeah.
It's just
very dangerous market to trade.
And the ULSD, the European diesel diffs to gas oil are a lot calmer for like August and September.
Right.
The sort of bow month, the very prompt month is still pricing quite high. I think it's about $23 diff to gas oil. But I think when you go into like August and September, it's about $11 or something.
Right.
And not chopping around like it was before.
Well, I heard there's a lot of buying in the call options on the spreads. So the CSOs on gas oil spreads. Again, with that whiff of like, we didn't see this coming. Let's just buy some outside, out the money protection.
Yeah.
If this goes really nuts.
Yeah.
It just has that feel of like market being caught out and finding its way to consolidation again. But again, you just wouldn't want to be short. I mean, if you do short and you have a good methodology in the sense of positioning or whatever, that's fine. But I just feel categorically like fighting a market that is all over the place and is still very strong.
Yeah.
So,
especially with a sort of physically delivered contract, which is short, which the region is still undersupplied.
Yeah.
You wouldn't want to be kind of shorting that as once you get to close to expiry and it sort of thins out the spec volume, you actually start to get to the real kind of people who need it versus the people who actually want to sell it. I think.
It makes the arbitrage modeling like more and more important, doesn't it? Because I think that with the refinery closures that the officials are talking about and generally the way things are going for Europe, seemingly inevitably, then it makes the arbitrage economics into Europe like basically what drives the market. Everyone's going to be fighting over themselves to supply Europe. That's going to be, that's actually something that I guess will maintain and makes Gasol a bit of like almost like what Singapore has been 10 years ago to 15 years ago. Do you remember like it was always about in Singapore, the fuel. So everything was kind of anchored about, well, what's going east though?
How much volume is getting our...
It's not about what's going east, but how much.
Yeah.
Because it always has to structurally go east.
Yeah.
And that was kind of how you read the market. And then from there, it feels like almost that's now going to have to happen with all the products increasingly into Europe as they diminish their refinery capacity and lose their energy.
You'll have that like kind of range of import volumes and you'll always constantly be like, where are we in like the kind of range? I remember fuel, it was like, it's like only 2 million tons has come in. Like that's super bullish. But then if the next month it might be like 7 million tons.
Yeah. So they're heavily like freight driven.
Yeah.
And so great for ship owners. Yeah, no, okay. Structural changes away. All right, it's a good time to talk about the crack spread Chronicles. So yeah, when we say crack spread, obviously we mean the refinery. So we've already talked a fair bit about refiners, but I guess if we just review the margins where they are again.
Yeah, margins have been very strong. Euro margins around $8.60. You've got the graph up on the screen. But Asia has been a little softer, driven by Dubai crude strength, which we'll get to in a second. And this is just broken down by product. Yeah, so this is just kind of graphic to show kind of the losses there, losses in EBOB. Gas oil, as I said, a bit of a correction. This is week on week, and weakness in data is giving a bit of a break to the margin as well.
It's still, very high.
Very high, yeah, still very high.
This is Singapore. This is Europe.
Yeah, this is Europe, and then the same graphic is here for Dubai. So you can see the red Dubai shows that that's increased. That can be a bit confusing, but yeah. So pressure from all angles.
So everything across the borders can kind of weaken the margin.
Mm-hmm.
But the margin's still
but it's still
strong,
very high,
it's kind of irrelevant. Yeah, I mean, it's still got the same dynamics at play. Okay, cool.
Yeah.
Let's move to who's been making money. This is the gold rush.
Yeah, so linked to that, we have the gold rush for this week, which is the Brent Dubai. We can see that that's sold off a lot. As you said earlier, this has dropped down to minus $1.20 in the August contract. We've seen trade houses selling the diff and buying the Dubai spreads. And there's the renewed strength in the sour versus sweet crude, kind of what the boys were saying earlier. And also kind of reactionary to maybe potentially the EU sanctions on Russian crude, because we've seen Reliance and BPCL buying Murban oil futures on ice as well.
Okay. Well, yeah, when we say the market's boring, this is the high volatile products like flat price, like the big headline crack markets like RBOB versus Brent. But, you go and look, and that's the great thing about this oil swap market and the wider oil market, financial oil market. There is always something to do, right? So as in, you just got to look a bit deeper. So yeah, the Brent versus Dubai differential, the market has been short that. Actually, I would say the bigger concentration of risk is short the boxes. They like to be short the front, long the back. So like short, July, August set, up north, all the way down this year maybe, against buying calendar 26. And those boxes have been weakening like very steadily. And then you kind of hold it into pricing and you basically get long exposure to Dubai. And that's a trade that's worked for years and years now. And it looks like, after a short blip, maybe 3 months ago, 4 months ago, when there was rumors of a lot of people losing a lot of money, it's come all the way back down. It's become a reliable trade again. And yeah, as you say, I mean, that's $1 since the Iran situation. It's a lot of money to be made given the scale you can get on a contract like that. And again, if you hold it like a box, not the outright. So what Martha was looking at there is an outright differential. I guess was that August? Mm-hmm. Yeah. And so if you hold August versus Cal, it's a lot less volatile and just quite a stable, nice trend. And you could put really big volume in that. So that's a quite industry specific trade that undeniably has made money. So that's quite a good one. Have you got any other gold rush? No. Let's move to who's been losing money then. This is the Widowmaker.
So another kind of extreme in pricing, we've seen 5-year seasonal lows in the Prompt 380 East-West. So this is the high sulfur fuel oil in Asia versus it in Europe. And that's a graph of it on the screen there. So we've reached levels of minus $20 metric ton. So we've seen weakness in 380 spreads, but the thing that was the Widowmaker is that we saw quite significant stop outs in the 3.5, so in the European structure, where that's kind of driven both of these things in tandem, kind of going each other way, and the legs have driven it to really low prices. And this is a good demonstration of that.
Yeah, I mean, it's surprising because, again, if we just rewind back to, let's say, May, when we were peak of fuel, we were kind of surprised by how strong it was. It was very driven by the East. It was all about 380. It had these huge spikes in the pricing spreads, and there was a big bullish story. And then it started to calm down, and we thought it was a good time to fade. And actually, we're talking about fading Europe. Turns out Singapore was the one to fade. has massively undercorrected below Europe. But again, that kind of makes sense with the refinery story, because if refinery capacity is low, then it's hard to produce fuel oil even. And so if there is an overhang, you would expect it in the east. So it's actually quite a logical sell-off. I wouldn't say I saw it coming at all, but it kind of makes sense in retrospect. And that's a very low east-west, right?
I think we talked about it the week, maybe you were away. I think we were talking about that the fuel traders at Onyx sort of said that after this kind of like, period of like super bullish price action, some physical bull plays in Singapore, you had like a bit of a overhang of product, and where like everyone was just sending like everything to the east because like the cracks were so high, east-west was super strong. And then basically what they were saying was, there's just this like incoming like glut of fuel which has been bought at very high prices, and now like the supply is not clearing, so the whole region is just kind of oversupplied all of a sudden, and no one's really buying it with the kind of conviction they were.
It's too late to reroute it to Europe, I guess.
Yeah, I mean, even with the kind of positive east-west which you had back then, it kind of didn't. It was probably still better just to suck it up and sell it in.
But now how negative that is. I mean, that's Was it -12? You said
-20 it went down to.
I mean, Jesus. So what is it? 6. So it's around $3 per barrel.
Yeah,
that's definitely going to pay for your arbitrage to move it.
Yeah, which is, and it's weird because you can't, having these like negative east-wests just didn't used to be a thing. And I know like obviously some of it was heavily linked to like the Russian product kind of skewing the sort of pricing mechanics, but sort of been a while since you had that like negative east-west in fuel.
I mean, it was a huge deal back in the day. I don't know if you remember, there was a big play in barges 2013, I think, when I think you hadn't started yet, and it was like, oh my God, the east-west is negative. Like, this is ridiculous. It was like the most insane play at the time. And now it's like standard. So I know what you mean, it's restructuring of the flows.
Yeah. I get there is a point where, if you look at kind of August, if the east-west goes negative, it's a little bit late to like do anything with it, but still like, things could be rerouted at like extreme levels. And
yeah, it's just it's so funny how there's a lot more oil traders these days, but the market is a lot more of an oil traders market. And what I mean by that is oil traders aren't looking to really punt long or short. They're looking to move all around the world. So when you have lots of politics, this is what you get. You get an oil traders market because you're just sanctioning off and rerouting, and this is how the oil market works. So it's not good for the countries that are essentially paying for all the EU are really doing in this scenario is getting the customers and the end users in Europe to pay oil traders to buy it from somewhere else and bring it to them. And so when you look at 200 billion a year being made in profits from trade houses and whatever else, that's the EU to blame, because that's where the sanctions are going. So the sanctions are blocking that oil, but you still need the oil, so you pay for the oil at the pump, but the price is made by the amount it costs to move from somewhere else. And the oil traders are making a big margin on that, and that's where it's going. So whatever you want to say, that's so it's like when you have like the reserve currency, like the dollar is, right? It's trying to act like the EU is the reserve, like for oil. It's like, mate, they're just going to go and find it somewhere else. Like, just because you don't refuse to buy it from Russia, there's so many other countries that will, and they'll just supply it back to you in another way. Like, it has no influence. If someone says, I don't want to use the dollar, that's why sanctions work, right? Because okay, don't use the dollar then. You're the one that gets screwed. It's a bit like when people try and box us in the market. We're like, you box us, you're going to lose because you don't get liquidity. Worse for you. So it's just like understanding like what will happen with or without you to really understand the control of things. But anyway, playing heads up, like, this is the problem with historical analysis. Like, for a long time, people made a lot of money just going, just whack up the charts, take the high and lows in the last 15 years, basically sell the highs, buy the lows. But what happens when there's a real structural change, which there seems to be all the time these days? You've got to be really, really careful, right? So it's just not.
Which is probably why, you have people stopping out on the east-west. Like, you can't really blame them, but if you've kind of trade any sort of historicals, buying a 380 east-west at -10 would be a phenomenal trade. You would bite someone's hand off for that, regardless of the fundamentals. Like, an oversupplied Singapore, maybe the 380 east-west went to like +8 or something before. Now it's just like, it could be 0, it could be -10, it could be -20. Like, what does it all even mean? That was just like a kind of it's not even like, it's like the diff number doesn't matter. It's just you've got Europe and Sing doing their own things.
Yeah.
And that just so happens to be the price difference between the two on a given day.
Yeah. So you've got to find some other methodology for how you dictate what's expensive or cheap. And again, as I said earlier, like arbitrage economics seems to be a big thing these days, and rightly so, right? Like you've got to track those things to know when things are going to move, or at least to predict hedging flow. If an arbitrage opens on paper, then the likelihood is then someone's going to want to hedge that to lock that in. So regardless of what you think the impact on physical is, that is flow that's going to enter the market, which can start to dictate your decision making. So yeah, to your point, or to our point, when we're saying something when it's super low, just buy it. It's like, well, you know, let's say, for example, the gasol east-west, this was a thing I brought up a couple of weeks back. And when it's super negative, you think, oh, I can basically move it from Sing and send it to Europe and make money. But what if the freight differential is also really high? Then east-west needs to get even lower. So you, as a simple way of putting it, you need to judge multiple things to be able to say, no, what is the actual justification for it being cheap?
Yes.
Because I need to factor in all the economics around it. So,
especially in a market like fuel as well, where like, you know, the sort of general mission is to not produce much high sulfur fuel. In Europe is probably not producing as much high sulfur fuel anymore. Like I think the stocks are really low, you know, refineries going offline, and it's probably not much of a kind of export to Sing play anymore. You know, it's just, there's just not that kind of like capacity. You know, a lot of it was from Russia. That, you know, that's not coming anymore like as it was. So just, yeah, it's almost like they're just two regions just behaving independently. And it just so happens that we always looked at the East-West as the difference, but actually it's just like, you know, that's just its own thing now.
Yeah, cool. All right, let's just finish this off with Crystal Ball. So not an enviable position to be in to predict what's going to happen next now. But I think that, look, I do like what Martha was saying at the beginning about a breakout, like looking imminent from a technical perspective. I think that's fair. I think, you know, even if it's a $2 or $3 per barrel, that would be historically, or at least recently, not a huge move, but it's enough of a move to make good money. So as a speculator, so I think that still on the lookout for a breakout is wise. You know, it could come from any number of tweets or whatever, right? So I guess I just don't know which direction that could go. But if I had to, like, gun to the head, say, I still think the market is highly constructive from a crude sense, and the margins, it's still the story, which can carry a market for a long time. So I think that given people are shrugging off the OPEC news, if it's going to break out, I think it's the upside personally.
Yeah,
Crude.
agreed.
Brent spreads, I think the same thing. Gasol, I wouldn't want to be short.
Yeah, I'm inclined to stay bullish all four.
Right?
Yeah.
I think I agree. Yeah. Martha, do you want to do some 10 press ups and then decide? Go on. What do you think?
So just looking in Brent, you can see the opposite. So looking at the daily candles, when it has a longer, lower tail, that's quite constructive because prices have dipped down, but they're breaking up above that now. And again, it'll be just important to see what it looks like today. I know saying all that will probably end up with a doji and more pinching in the Bollinger Bands, but I think, yeah, it's been pretty primed for an upswing. We've got nice higher lows and more sideways highs, but yeah.
Okay. All right, we will leave it there. Again, thanks as always. And this is, as I said at the beginning, the last show in its current format. So, look out for more shows. We're going to get more and more interested in some of the more minutiae. We're going to be bringing in power and gas type stuff. But again, the main high value content with all our proprietary data, our analysis, our deeper insight, that's going to be available on Flux.live. And over time, it will then move to just the platform. So please get a trial on the platform, see what it's all about. $400 a month for the best data out there. Really can't be replicated, and a deeply liquid platform as well. So very cost effective for what we think is cost effective for everyone. It's going to be, you know, a fraction of the cost of your Bloomberg terminals, your extreme subscriptions out there. So please, worth taking a look if you're still interested in keeping in touch with these shows. But it won't be the end for YouTube. We will have plenty more to come. So see you again soon.